As I matured as an investor, the way our portfolio looked has changed. And the way it changed is that I started to realize life is too short for me to own, kind of low quality companies. So for us, quality became this kind of absolute bar.
I'm curious how you think about time when it comes to the reward. At the IMA dinner, you mentioned one of the interesting things about investing is you don't know when the reward comes, and you just quoted Seneca. How do you deal with the opportunity cost of time, especially in a market where price discovery seems to be impaired, or at least working differently than it did in the past? Thank you.
That's a great, Jerome, thank you. Great question. So we integrated this into our investment process. And let me explain how we do this. When we look at a company, every stock in our portfolio, I'm trying to figure out how to explain a spreadsheet in words. But basically what we do, we put a fair value on the company 4, 5, or longer years out. And then we discount it back. So why it matters? Because let's say there's a company that's not growing earnings. And then let's say there's a company that is growing earnings. So if I put a company that's growing earnings 5 years out, actually I'm getting paid with earnings appreciation, right? Now, if I put this, another company on the same scale and 5 years out it's not growing earnings, then time is actually working against that company. So therefore, the discount at which I buy the stock has to be much greater. So in other words, if it takes 5 years for the market to revalue the company and it's not growing earnings, I have to buy it so much cheaper. So we have companies with different growth profiles, but internal rate of return 5 years out basically equalizes that. That's how we deal with that. Another thing it does, it introduces companies in my portfolio. Like when I started investing, I feel like, I feel like every investor, every value investor goes through this transition. You kind of start in a dumpster, like you start buying these companies that look very cheap, like look statistically cheap, and say, oh God, look at this, look at this wonderful coal stocks at 6 times earnings. Okay, this is how almost every value investor I know, this is how they started investing, right? Because and it's easy and it actually makes sense, and this is how I started investing as well. Because the reason it makes sense because I got my master's degree in finance. I've been taught how to look at a lot of numbers. So it's so easy to say company that's traded 10 times earnings is cheaper than a company, statistically cheaper than companies traded 15 times earnings. But so it's easier for us to grasp this simple algebra or arithmetic. Now, the true analysis comes to understand, well, okay, this company has a significant competitive advantage. It can grow earnings for a long period of time, right? This company has good management and bad management. This management is good at allocating capital, this one isn't. This one may not look like it has a lot of debt, but has a lot of releases or whatever. So this becomes qualitative analysis. So I feel like a lot of investors start with quantitative analysis first, like quantitative looking at statistics, and then they graduate after they lose a lot of money and make a lot of mistakes, like I did. They kind of graduate to to adding qualitative factors to that. And growth, there is a value in growth. I am a value investor, and one of our largest positions is Uber, as you guys know, and because there is a significant value when the company doubles or triples or quadruples its earnings, right? The company becomes worth more. Now it matters how much you pay for it too, by the way. So it's not all, it doesn't mean that anything is growing should be bought, but introducing these elements into your portfolio. And if you look at, a lot of times you look at our portfolio, like if you were to be analyzed by a consultant, and they would look and say, well, you're a value investor, but you own Uber, so it would break their models. Well, to me, it doesn't. It's their problem. But anyway, so we want to integrate all these components into a framework, and the way we do this is just by valuing putting all the oppositions and 5 years out and discounting them back. So hope I answer your question.
May I ask a quick follow-up?
Yeah.
Just because you touched on competitive advantages and sort of the multivariate aspects, do you adjust, obviously, not all earnings growth is equal.
Mm-hmm.
And if I think about companies that have wide moats and the capacity to generate significant excess returns, so returns above their cost of capital,
mm-hmm.
how do you factor that in? Because you can have a company that's growing earnings, but to the detriment of its ability to generate excess returns over time. So just curious how you incorporate that in that IRR analysis.
Well, I think the math kind of speaks for itself. And if company does not earn its cost of capital, then to generate those earnings 5 years out, they're going to have to either increase debt or raise equity, for the most part, right? So we're simplifying it. And also, that company probably not going to pass our quality screen. So there's a kind of several mechanisms that kind of, I think quality, we are, when I, as I matured as an investor, the way our portfolio looked has changed. And the way it changed is that I started to realize life is too short for me to own, kind of low quality companies. So for us, quality became this kind of absolute, kind of bar. So if I see it's a company that's, I'll give an example. We were looking at a company recently where it's probably one of the cheapest stocks I've ever seen in my life. It's like something where I could objectively say this was a dollar trading for 20 cents. Absolutely. But then if I started looking at the management, and I realized it has the management that, it's $3 management for, kind of for dollars, It's that the management that run the company paid themselves a huge amount of money. They made horrible allocation decisions in the past. And like the old me said, well, look, but this is a cheap company. The new me basically says, life is too short and move down. So that's how I deal with it, I guess, yeah.
Very helpful. Thank you so much.
My pleasure. Hey, thank you for watching this video. If you want to learn more about life, classical music, philosophy, and investing, make sure to subscribe to my articles and visit investor.fm. Thank you.